you want an exposure to a market or an
Everything they need in one place.
Be the world's foremost authority on
Individuals, advisors and institutions.
Hello and welcome to Morningstar. Today I'm joined by Peter Warburton. He's the director at Economic Perspectives, and we're going to be looking at what investors can do to protect their investments from inflation. Peter, thanks for joining me.
Pleasure.
So you recently gave a presentation in which you talked about how investment returns can be split between sort of real returns and that inflation protection. Can you explain what you mean by that split?
Yes, I think in a growing economy, and obviously for the last 40, 50 years, then that's happily been the typical state of the global economy. It's been growing. Then, in a sense, your investment strategies are to capture that growth. Typically in equities for the main, but obviously some pretty good real returns have been obtained in bonds as well. So if you like the harvest of global growth has been obtained in both equities and bonds. But really that isn't always the case. And there are times actually where protecting yourself against high and volatile inflation is very important. And I want to argue that actually we're approaching one of those times again now.
So let's sort of take the two parts in turn. First off, that's sort of the yield element triggered by the global economic growth. What's your current outlook for that area of return?
I think it is to slow, and I mean there are a number of arguments, and I think everybody would probably put a different weight on each one. But there's a demographic argument that in the advanced countries the population of working age is growing slowly or declining. There's an argument about energy becoming more expensive, and if you like, putting more effort into getting energy and less effort into everything else. But that's gone into a reverse slightly just very recently. There's arguments about the debt that we built up, particularly in the 1990s and 2000s, and whether that was pulling growth forward from the future. And now we're in that future which is impoverished. So there are all kinds of arguments that people make, and I think quite credibly to say that our growth outlook is weaker than it was.
And so for the inflation side of things, and obviously for average man on the street, the idea of prices inflating is bad news because it hampers your purchasing power. But is there a sort of positive side to inflation as well? There's
certainly beneficiaries of inflation as well as losers. But I think the key thing is that we have lived through an extraordinary period where certainly government bond yields have fallen very low, and many people believe that this is associated with a deflationary future. And I think that's a very dangerous assumption or assertion to make. I would say that we've got some very sort of distorted bond markets at the moment, obviously through quantitative easing, forward guidance, and the repression of interest rates across the curve. And actually we are extraordinarily vulnerable to reversal of inflationary trends. And what a rise in inflation would mean almost certainly is that it would not only have a negative impact on bond returns, but it would probably derate equities as well. So I think this is a time to be thinking that actually inflation protection is actually quite cheap, in fact very cheap in markets at the moment. So this is the time to be looking further ahead and considering how differently the world might be.
So obviously no one has that crystal ball. It's very difficult to guess what's going to be coming ahead. But what are some of the key tools available to investors to build in that inflation protection into a portfolio?
Yeah. Yes, I don't think you can inflation-proof a portfolio, but you can protect. And obviously there are available in most countries inflation-protected bonds, so TIPS in America and index-linked gilts in the UK and so on. What's been quite interesting is that they've actually performed well even as inflation has fallen. So the real yield aspect has actually delivered a return, even though the inflation hasn't. But no, I think were we to resume inflation moving up towards 3, 4, 5% or beyond, then you very definitely want to own inflation protected bonds. Obviously, some countries you don't get proper compensation. So if you go into the emerging markets space, then you definitely don't get full compensation from your bonds. Other things, I think obviously you can, if you're sophisticated, you can buy inflation derivatives, but I would say those are trading strategies rather than long-term investments. I think most of your inflation protection really is in equities, where you can get companies that own real assets, physical assets, and also have franchises in products and services which are enduring, and therefore they are enduring, and therefore they are inflation protected to some degree. Outside that, I would say that real estate, particularly commercial real estate, is a very interesting part of inflation protection. Provided clearly that those investments are not using leverage in the short end of the market. So obviously, if you were to get a sharp upward move into short-term interest rates, then that would more than offset your inflation protection in the asset.
And of course, for those people who have a mortgage as well, there'd be a double whammy, as it were, there.
Yes, that's right.
Peter, thanks very much for explaining those options for us. Some very useful information.
You're welcome. Thank you.
For Morningstar, I'm Holly Cook. Thanks for watching.